Yes, sir. So before we proceed to the next question, yeah, just want to go back to the previous question and just want to know, okay, how did you get that 63,066? Because we passed this accounting entry and we debited to retained earnings 66,066. Okay, in the examination you can cross verify, because we know that in this question it was exactly 2 by 4 or 50%. So in the exam they will give you some other 3:1 or 3 years or 5 out of 5 years. So you can cross verify this number. Just check expenses claimed as an at a contractual rate 3,60,000, premium charged 1,50,000 versus how much you should have charged as per 109 at the rate of EIR. This difference should be your P&L hit or retained earnings. So this you can cross verify, and same thing we have done in 116 also, so that you are very sure that your workings are correct. Yes, H Limited has the following assets and liabilities on 31st March 2011 prepared as per previous gap. See, the moment you see this previous gap, you understand that this is 101. This concept comes only here. Now the fixed assets are 1 crore 34 lakhs. Investments in S they have given. Now who is this investment in S? We don't know. Is it a subsidiary? Maybe. Debtors, advance purchase for inventory. So they have made some advance payments. VAT deferral loan. Seems like a government loan. Creditors, short term provisions. Now ESOP reserves are sitting. Cumulative translation difference is there as per Ind AS 21. 102 ESOP reserve is there. Okay. Now the following gap differences were identified by the company on its first time adoption with effect from 1st April 2011. Now this is the balance sheet when 31st March. So we understand that the transition date is 1st April. Now in relation to property, plant and equipment, have I given this sentence there? This particular sentence is available in your book. Okay. The following relation to the PP, property, plant and equipment comprise land held for capital appreciation purpose costing rupees 4,50,000 and was classified as an investment property as per 40. So now what happened? They have given you one. See, first of all, this particular presentation is not applicable to us now. This is accounting standard presentation where they start with the fixed assets. We call it PPE. It starts with the liability, and then when it comes in liability, they start with the reserves and surplus, share capital. We don't call it reserves and surplus, we call it other equity. And then it will, when it comes to assets, it starts with the fixed assets. We call them PP. Now there is no separate heading called investment property for them, but we have got a new heading now. So we have to bifurcate this from here. We have to pass one accounting entry. What is that? Land to land, but the reclassification from fixed assets to or PP to your investment property. Now exchange difference of rupees 1 lakh were capitalized to depreciate the property, plant and equipment on which accumulated depreciation of 4,000, 40,000 was recognized. What is this story? Whatever forex loss they had incurred, what they had done? They capitalized it. You understand the background now. Now on that capitalized forex loss, they have claimed the depreciation. Now what does standard says? Leave it. See, if you want to revalue, do the revaluation. If you don't want, you want to take the previous balance, you take as it is. And it is not disconnected. See, like it has nothing to do with the policy. You can stop the policy, you can continue here, or you can do the revaluation, you can continue with the policy there. That's what the standard says. Both are two different aspects. There was no asset retirement obligations. What is this? Yeah. That's what they say, that you need not do this. Okay, what you have done, because Ind AS also permits you, if you are already into that practice, you can continue the practice. You are not into that practice, now you cannot say, I want that. If you want, you continue, then you continue depreciation, which is against our Ind AS principles, but we are okay with that. What is this? There was no asset retirement obligation. Decommissioning liabilities are not there. Otherwise, I don't know how accounting standard. I need to figure out the decommissioning liability, pass one accounting entry now. the management intends to adopt deemed cost exemption using the previous gap carrying values. But when they adopt this, they have to adopt to all the class of assets. If they don't want, they could have done revaluation on case to case basis. So what they have chosen? Okay, only one thing we have to do here is reclassification for the land. Other things we will give the note that there is nothing required. Second, company has made investment in S, who is a subsidiary. Okay, now we understood who is that S. S is a subsidiary for 48 lakhs that carried a fair value of 68 lakhs at the transition date. The company intends to recognize investment at its fair value on the date of transition. Can it do? Yes, it can do it. Is it permitted under Ind AS? Which standard? Which is this? That clarity you need to have. No, when you are reading, otherwise how do you comprehend what investment? It's an SFS. Nobody is going to tell you that. Followed? No. See, sometimes they will tell you, and sometimes they will fool you also. Heading may be cash flow statement. One problem we have seen that institute has given heading cash flow statement. So they will try to pull your legs all the places. You need to have that clarity. Okay, you see that is an SFS because investment is shown. Now, can you show at a fair value? Which standard? 27 has permitted me. Now, the difference will be going to the retained earnings. So, I have to pass one accounting entry here for what is my accounting entry? Investment account debit to. There is no P&L, no. It is a retained earnings. If I have done this on the day one, cumulatively my P&L would have increased, no, by now. So, that effect I am giving right now. Now, there is a VAT deferral loan. What is this VAT deferral loan of 60 lakh rupees? The VAT deferral loan was obtained exactly on the date of transition. For means next day, for 1st April was the date of transition. Just one day before I got one loan. Now, for setting up the business in backward region with a condition to create some targets and all, repayable in 5 years time. As per 109, the discount factor to be 10%, being the incremental borrowing rate, which is my comparable or whatever. Accordingly, the fair value as on 31st March was 37 lakhs. Because this interest, is it an interest-free loan? Does not carry any interest. You took on 2001, 5 years down the line, you need to pay. So, if you discount this 60 lakhs divided by 1.10 to the power 5, its present value comes to 37 lakhs. An entity chooses to exercise the option given in Ind AS to split it, financial instrument and a government grant, retrospectively, as required information has been obtained. What does my Ind AS 101 says? Look, when it comes to government grant loans, like interest-free loans or whatever, you need not bifurcate. From now onwards, like from 1st April onwards, you continue without bifurcation, telling it is your financial liability only. Alternatively, if there is one choice for you, if you want to do it from the day you have taken the loan, you can do it. Who has stopped you? But you need to have the information. Very first question what we solved, there was no information. Loan is of 2012. So we started from prospectively without bifurcation. But here problem is, not problem, here just yesterday only I got this loan. So I cannot say no, I don't have any information. So information is readily available with me, my discount rate, everything. And I have opted here to split it. Okay, so if I have opted, then on day one retrospectively you have to do. In exam, this 31st March 2011 can get turned into 2010. Followed, no? Then and if they say that they have opted, this opting you have to split 1 year before, when 31st March 2010, you have to prepare an amortization schedule for 1 year. Not required, because yesterday only I received. No, today morning I am converting it. So amortization doesn't come into picture. No deferred income, because 31st March when you receive, chalo, you would have split only. What accounting entry would have passed? On 31st March only you received this grant and you split this grant. What entry would have passed? bank account debit 60 lakhs, to loan 37 lakhs, to government grant deferred income. How much? Balancing figure. Will you recognize any amount in the P&L account? No. But if the same loan was obtained 1 year back, something I would have amortized into P&L account, interest cost, and some grant portion I would have taken to P&L account, provided it is covered by which standard? This grant should be covered. Which all standards cover the grant? 20 and 41. 40, if they say it was 41, I may have to keep it till the conditions are met. Since it is 20, I am doing this. Like yesterday, okay, since we are here, yesterday we have seen, like previously we have seen one question on coconut palm. Now you remember, coconut palm means it's the landmark. Now in that case, if they say government grant also received, which standard is applicable? Followed, no? Yeah. 20. See, that clarity you need to have, because see, it's just a plug and play. No, every concepts are plug and play. It's not required that you have to solve everything in one problem. Most problem you understand. They will mix it. If I will say no, it is India 60 is covered, so India 20 will become applicable to me. Okay, so 1st April 2011. Opening balance sheet. No. This transition date is the, see, in this case what I do, no, I prepare 3 balance sheets. This is my current year, this is my previous year, this is on 1st April 2011. All the adjustments I will do here. Automatically it will flow here, automatically it will flow here, and this becomes full Ind AS compliant financials. It is called a 3 balance. No, you are preparing today. Generally when you prepare any balance sheet anytime, as per Companies Act only you give comparative. But in case of retrospective restatements, in case of first time adoption, that year balance sheet will have 3 columns. First column is current year, second column as usual your previous year, and there is one more third column coming into picture called first day of my previous year. Everywhere, in real life also, in exam also. Here see, you have to just prepare transition date. Why have they told you current year balances? They didn't tell you. Afterward, now from now onwards you should continue to prepare. Okay, if you split this value, no, if you have split this value, from now onwards you have to prepare, and for the year comparative period 2011-12, you have to charge some P&L, and 12-13 is my Ind AS year. Are you clear? So this part is clear to you. The retained earnings of the company contain the following: ESOP reserve, we have already seen. Now the company granted 1000 options to the employees. Out of this 800 already vested. So do nothing. Standard says if it is already vested, take the balances as it is. Intrinsic value, they have 12,000 has been vested options, and 8,000 over a period of time as a ESOP charge for the corresponding reserve for the unvested portion. No, wait. They are already vested. The company followed the intrinsic value method for recognition of ESOP charge. Now, what is this intrinsic value method? Make Black and Scholes model or something to calculate the intrinsic value of this option. They recognize 12,000 for the vested options and 8,000 and rupees 8,000 over a period of time as ESOP charge and corresponding reserve. If a fair value method had been followed according to 102, corresponding charge would have been 15,000 and 9,000 for the vested and unvested. So out of this 20,000, 12,000 was towards vested, 8,000 was towards unvested. If you would have followed this under 109, 102 Ind AS, it would have been 15 and 9. What standard says 15 you forget, but the 9 you have to restate, and the differential amount will go to P&L account, because otherwise it will hit your P&L. No? P&L means retained earnings. The company intends to avail the Ind AS 101 exemption for share-based payment, not restating ESOP charge as per previous gap for vested. So if it's your choice, if you want, you go and restate it. If you don't want, don't take it. But this choice is not available for unvested. This is compulsory. Compulsorily you have to fair value it. Retrospective is going to come. For the vested portion, retrospective need not happen. If you want, you can give that effect. Now, what is cumulative translation difference? There is a 1 lakh rupees which is because of the non-integral foreign branch as per 11, AS 11 talking on non-integral. What is this integral and non-integral? In Index 21, have we not discussed when do you say that foreign operations, like it should be indicators, functional currency? If you have got a foreign operation, have you given them substantial autonomy? Have you given them free funding? Can they take the decision? If your answer is no for that, then that foreign operation, what you call, no, it is not an independent, it is an integral portion of your thing. Then what is the functional currency of that foreign operation? Rupee only. Then where is the question of translation? Non-integral means it is an independent autonomy in it. Its functional currency is totally different from what you are using. So tomorrow, when you have to do consolidation, you have to do the translation. So translation result is going to come only for a non-integral part. How important, no? One word. Understood now? Now, they had recognized 1 lakh as part of the reserve, which is a credit or debit balance. It was a cumulative gain or a loss. To pass the journal entry, you should know, no? It was a loss. How did you know? Go back to the balance sheet. No. See, you have got a translation reserve here. Is it a negative balance or a positive balance? It is a positive balance. That means you must have made it to cumulative gain. No. So how do you close this? Because there is one option. No, you can set it 0. How? Transfer that reserve to retained earnings. And you can clean your balance sheet and you can show it like India's balance sheet. Previously, it is an accounting standard balance sheet. Different format, different numbers, different treatments, different adjustments. See, now you transit. Do you get the feel now? You look at the final balance sheet, no? It really gives, at least it's not foolproof, huh? Not perfect balance sheet of India's, but a reasonably good balance sheet of India's. So, they availed the exemption of resetting the cumulative translation reserve to 0. Yes, they opted. If they would not have opted, they would have continued. Okay, that's it. So, what you need to prepare after giving all these adjustments, you have to prepare first time balance sheet. Okay, first write note. Solution. Okay, we'll write a short solution. 1 PPE. Land to be reclassified into investment property. No adjustment for past capitalized forex difference as deemed cost option. Since you have opted for deemed cost, like take the previous balances as it is, there is no adjustment is required for that. And the land, what you have, it should be reclassified into investment property. That's it. Because you cannot simply prepare a balance sheet, you have to explain. It's like more like a notes. Okay, maybe in the exam you can write with the proper beautiful English like what I have shown you here. Then I will move to the second point, investment in subsidiary. Company can opt for fair valuation. Difference of rupees 20 lakh in retained earnings. So they can opt. It is not that they cannot opt it. If they want, they can move. And any difference of this fair value adjustment, what you need to do, you have to take it to the retained earnings. Okay, maybe very detailed explanation like this. On first time adoption, the parent company has got an option to shift it to the so and so in the separate financial statement, because in the CFS this question doesn't come into picture. And you can take the fair value gain, the difference between 68 lakhs and 20 lakhs to read in earnings. Next, VAT deferral loan. Entity opted for retrospective split into loan and government grant, which is permitted. If you didn't have information, you need not split it, but you should have prepared one new amortization schedule, because your loan amount is 60 lakhs, which is repayable in next 5 years. At what rate? IRR 10%. You should have prepared an amortization schedule, go and charge going forward. Since you had information, just it was one day before, so you say that the entity had got an option, chooses the option to exercise, to apply the requirements of both 109 and 20 retrospectively, because you had all the information, thus you have to split. Is it going to impact your retained earnings? Is this exercise going to impact your retained earnings? No. Your accounting entry is VAT loan account debit to VAT loan debt to deferred income. If this loan was just obtained 1 year before, then it will impact, because some portion would have gone to P&L account, no, as per Ind AS, but you didn't do anything. So what should have gone to P&L? That is the point of retrospective, no? Because till now you have been restating, you have kept your balance sheet inflated there. No, I didn't get you. When you transferred? 1st April. Because now onwards it will. If your comparative is going to change now. In the comparative financial year, since you already recognized, what is your opening balance this year? This is your financial year, no? This year, is it 37? No. Is it 22? No. 1/5 of 22 you would have charged to P&L account. So last year P&L, if somebody goes back to the previous annual statement, annual report, they open the annual report, they don't see any deferred income there, credit to the P&L. But today, in a comparative, you see restatements. Now, in days 10, you have to give disclosures there. Why you are doing like this? Next is ESOP. Entity opted not to restate vested options, non-vested to be restated with impact of rupees 1000. How did you get 1000? If you would have done as per 102, today its value would have been 9000. What is the book value? 8000. How it is 8000? Because you have been charging less expense to the P&L account all these years to retain earnings. So you say that as per 101, it provides an exemption for all that options vested. You need not restate, but non-vested has to be restated. So the impact will be taken into the opening retained earnings. And the last one is the cumulative FCTR or FCTR, you can write, foreign currency translation reserve. Entity has opted to set FCTR to 0 with transfer to retained earnings. It's like more like a recycling. It's more like you are telling, okay, forget about foreign branch. I don't know what references, how did you took this foreign currency translation reserve. I will give you an option to treat it, okay, close it, you start a new fresh account. And they have opted for it. Okay, followed, no? With this, we are ready now to do the accounting, and see, again, very nice question. After this question, I started to understand what is 101. Balance sheet. Yeah. Otherwise, how do you know, how somebody knows why you did this shifting? Now you see, now in the transition balance sheet, we will do some shifting, we will take one reserve balance. How do you know now that this transfer has where to go? That you are to, in the previous balance sheet, FCTR was there, new balance sheet not there. Where it has gone? So this is like more like a notes to accounts. You explain what you did for that. So calculate the retained earnings adjustment. See, I'll show you here. Okay, there is one catch. Catch in the sense the institute has done in one way now. That I'll show you. Easy, but our institute, you know, no. Simple things, they split into 2 steps to make you confused. You think if it is okay, please try to follow them. So, how much, what all the adjustments are going to hit my P&L account? Can you tell me retained earnings? You have written so many notes now. Go by one note. Note number 1 is going to hit my retained earnings? No. Fair valuation of subsidiary, S Limited. Fair valuation of S Limited. Am I going to debit retained earnings or credit retained earnings? So write credit in bracket 20 lakhs, because otherwise you will not come to know. Simply plus minus, you don't get into it. We have understood plus minus is nothing but debit credit. Next note, is it going to hit anything into retained earnings? What is the next one? Deferred, no, nothing. Next note, yes, ESOP reserves are going to get. Are you going to debit retained earnings or credit retained earnings? What entry you are going to pass? What should have, what happened? What should have happened? Huh? Should I debit retained earnings? Should I credit retained? Everyone okay? Debit retained earnings? Yes. Understood? No, it's not the formality, like format. Just you go and fill, you understand. It can be anything in the exam. Why you have to debit? Because you have been claiming less expense. Your expense is going to increase now. So how much? 1000. Next you have got what? So what is the next note? FCTR. FCTR, what you are going to do? Debit or credit? What balance it is? If already a credit balance, you have to set it 0. That means you debit FCTR, and what you are looking, what you are going to do with the retained earnings? No. Because what you are going to do with the retained earnings? I am not asking what you are going to do with that FCTR. FCTR you are going to debit, but retained earnings you are going to credit. No. Because I want to know at the end of the year. Instead, I should have told you, please pause the video and tell me what is the closing retained earnings balance at the end of the year. It means on the date of transition. Then you would have understood it better. So now you write 1 lakh credit. So your retained earning adjustment, no, cumulatively is 20 lakh 99,000. If you want, you can pass one single entry with all this adjustment, and that balancing figure would have been 20 lakh 99,000. All this adjustment, no, one single entry would have passed. See, institute, again, since already in 110 we have understood how to prepare a consolidated balance sheet. They have prepared a balance sheet in a different way, like they have given you previous adjustment like this, previous adjustment, previous balances, current adjustment, Ind AS. If they tell you with the schedule 3, notes 3 and all, no, then we know that this type of thing presentation is not applicable. You have to write particulars, note, Ind AS. In the note, you have to give that breakup. Followed, no? If the question is silent, as per working or something they give, you can do it this way. In the study material, they have done this way, but look into the exam question. First, I'll start with the non-current assets. Under non-current assets, I have got PPE. My note number 1. Note number, which one it is? My adjustment. We started to write, no? what we will do? That note. Huh? Now clear, no, Dhanashree, why we have to write those? In fact, you can leave some space, write note, go at the notes to accounts and write all these stories. Now, your previous balance was 1 crore 34 lakhs 50,000. Was there any adjustment? Yes, how much? Plus or minus? Minus 4 lakh 50. Agree. See, this is what they have presented. Okay, if you want this, you can shift it to the notes to accounts, where you just write the particulars, note number, Ind AS financials, rupees, where note number 1, you go there as per previous gap minus this. Followed, no? That is notes. Then there is notes to accounts. This is note number 1 for that, for this amount. But here what they are treating, we are treating this as that notes to accounts note. There are followed, no? Anyhow, you see, if it comes, you already know, no consolidation. And that you can say as a working note. Ind AS gap, how much? 1 crore 30 lakhs. Second is what? Investment property. We have to go as per the standard. This is also note number 1. Was there any previous gap balance? No. Is there any adjustment? Yes, the land gets translated into a investment property. So 4 lakh 50 is your Ind AS balance. Clear, no, Prithvi? Is there next one? Financial assets. Under that you have got investment in S Limited. Note number 2. What is your previous gap balance? 48. Is there any adjustment? Yes, 20 lakhs, add or minus? Add. Where is the second leg? Retained earnings. That's what we have worked out. So this becomes 68 lakhs. Now that's what, no, it's very easy. Transition is very simple thing if you have understood it. Balance sheet they will ask you. You have to just prepare, you know the impact. Only thing is what adjustment need to be done as per 101. Is it a prospective? Is it a compulsory prospective? It is retrospective, compulsory retrospective. Is there an option there? Can I take the previous balances? That's what you need to answer. Then next, I'll go to the current assets. And this format is coming from your schedule 3. It has nothing to do with your in 101. Under that, first I have got inventory. Is there any adjustment to the inventory? No. So I will take the same balance. Obviously, no, because AS2 and Ind AS2, your numbers are also same. Some adjustments are there, some differences are there. Is there any differences? Have you come across any exam question? In AS2 and Ind AS2, is there any differences? Was there any exam question which they may ask you? There was one theory question, no? Spare part was there, insurance spare parts, how do you treat it? No, inventory related. Spare parts, insurance spare parts, how do you, there was one theory question, there were 3 points there. What all the difference between AS2 and Ind AS2? But if you see every single standard gives the difference called carve in, carve out, difference between accounting standard and this thing, not important. Academically, if you want to study it, please study it. But those questions which they ask you specifically RTP, MTP, don't leave them. Disclosures, everywhere it is there, not a priority now. But certain things specifically ask about disclosure, study it properly. Now, next is financial asset. Under that, trade receivable, no debtors. I have written here debtors for your understanding, because we don't call them debtors anymore. No adjustment, obviously no. Because for debtors, the only value, how debtors are going to change? Which one? No, advances are becoming my other financial. It's not a financial asset. It cannot be classified as a financial asset, because is that advance received from the customer financial asset? No. Where? Advance for purchase of inventory means you have given one advance to the creditor to purchase inventory, supplier. Now, is that financial asset for you? Have they told you? Generally, what is the general practice? They will give me, no, supply the material. So it is not my financial asset. That's why I will not show under financial asset. I will just show trade receivable, cash and cash equivalent only I will show. Separately under financial asset, I will show inventory advance. Followed, no? I will show under financial assets only, not under financial assets. I will not show. So after this, you have got a cash. You will enter the cash. There is no adjustment. Just tell me what is the doubt. Perfect, no? Yeah, because my current assets, generally there should not be any adjustment. No, we started with estimate, because debtors what is going to change, inventory what is going to change because of the estimates only. But estimates in your accounting standard and India should be same. What it has to do with the accounting standard? It's your practice, it's your skill. So transition is very smooth, no? Okay, in your new scheme, transition also going to happen like this only. This is your previous syllabus. Very few adjustments in the existing syllabus, and you are into new syllabus now, May 24. You will never realize only. Correct, no? Okay, so now next we will move on to the equity. How much is my equity share capital? 1 crore 30. Was there any adjustment? Can they give? That loan was treated as an equity there. You remember in the first question? That can come here. Then that loan, other equity, that's what, not here. Other equity it is going to shift now. So there is no adjustment here, 1 crore 30. Now, other equity, what is your cumulative translation difference? Note number 5, 1 lakh. Was there any adjustment? Yes, minus 1 lakh. No, it's 0 now in new balance sheet. ESOP reserve, note number 6, 20,000. Was the adjustment plus or minus? Add 1,000. Second leg comes in the retained earnings. Retained earning balance is 1,79,000. And you take this cumulative adjustment wherever it has hit your retained earnings, no? The second leg is not there, is sitting in the same balance sheet. It will come to 20,99. Clear? Yes. So can I move further? Now I'll move to the liability portion. Non-current liability. Under this, sales VAT deferral loan. How much? Note number 3. Previously it was 60 lakhs. It would have been 60 lakhs if I would not have opted. So plus or minus? Minus 22 lakh or 32 lakhs. How much is minus? How much I should minus? Here luckily they didn't give 30 lakh, 50. Correct, no? Here also, how should I, are you sure? Yes, 22 lakhs is what I am going to reduce. Just think in journal entry, finish, problem is solved, 37, 25, 528. You understand that in final FR, this is what I am going to propagate now. Index is simple, it is only journal entry. Now new item is going to come, which is that? Deferred government grant. Current, okay. Anyhow, very good. I was also about to come there, but they have not done it. They have taken full. Otherwise, if you know the conditions or whatever, how you are going to amortize it, one portion from here will get shifted under current portion. So there are some specific questions meant for it. That's why when you see this question, you remember, oh, this question is that question. How they have done it? Have they classified? No, no. If you want, you can classify it. Otherwise, just dump what they have done in the study material. Followed, no? Why? Because the question is silent, no? About amortization of this. Next, you have got current liabilities. Is there any change in the creditors? No, not possible. Understand? No, because it's the same. No. What treatment you will give for creditors in two different standards? Short-term borrowing? No, there is nothing hiding. Is that an off market and all not there? Provisions should be same. What provision you make for the previous and the new gap? Yeah, you call it trade payables and all. Don't call it trade debtors and creditors. With this, you are done with the total balance sheet. Are you clear, students? Yes. So now I would like to show you one difference here. Yeah, sorry, it is not this question. There is one more question called Shaurya Limited. Okay, so here what they have done is the same thing. You can do it like this. That Shaurya Limited, no, the same simple only. This balance, that retained earning balance, no, they have done opening balance, add and all, which we showed in a different way. They are going to show it in a different way. We'll discuss that. Okay, take out question number 5. Now, XYZ Private Limited is a company registered under Companies Act and following the accounting standards. They voluntarily decided to adopt Ind AS from 1st April 2018. Okay, in Ind AS applicability, we have this. And their transition is 1st April 2017. That third balance sheet, what they have to prepare, no, that is this, on this day. The company has got one wholly owned subsidiary and one joint venture. The consolidated financial statement of the company under Indian GAAP has been given, which is accounting standard. So they have given you on 31st March 2017 and 31st March 2018. Now we need this opening balance. Now share capital, reserves and surplus, borrowings, other provisions, PP, goodwill on the consolidation of subsidiary and joint venture. See, we know that in India's 28, subsidiaries, what is that called, joint ventures, goodwill is subsumed in investment. And if you see the balance sheet, there is no investment shown here. Where? Investment property, no? What is investment in joint venture? Are they supposed to show? No. Which investment? No, trade receivables are different, no? Under this investment, no, you cannot show it as a current investment. If you have invested in an associate or a joint venture, it would have been a long-term, non-current investment. So they have not shown. Like what adjustment they have done that now? What must have happened? Let us see. The company entered into joint venture by acquiring 50% of the equity shares of ABC Private Limited. Now the presently same has been accounted using proportionate consolidation method. Okay. In the previous accounting standard, just like you would have done consolidation of the subsidiary by taking 100% of the assets, even though you don't have 100%, say your stake is only 80%, like the same thing was applicable to joint venture. But under Ind AS now, meaningless. No, you cannot continue like this. So Ind AS cannot permit you. That's why they didn't say take your all the values as it is, because it will, you would have got one weird values there. So maximum wherever possible, they said, okay, PP should not be any change. If you want, you take previously. Debtors should not be any change. Take the previous value. Investment property, wait. Land should have been investment property. Loan, wait. Have you mixing anything there? Split it if you want. So like this, certain things they have told. Now this is one big blunder. Like, I don't say blunder. It is a big. These numbers are not meaningless only in India, because these numbers are mixed with the assets of that particular joint venture in 50% proportion. And they told you the proportionate share of the assets and liabilities included in the CFS only, they have told you now. The investment is in the nature of joint venture as per 111. That means it is a joint arrangement. In joint arrangement, it is not joint operation. Possible? No. It can be possible that it is a joint operation. Then how we can keep, Baba? Then we should keep respective assets and respective liabilities, no? Because it's whosoever assets. Now what I have taken out of 2,400, I have taken 1,200. All assets 50% I have taken. That is also wrong now. Then what if it was an operation? Then they should have told me at this list which is your asset. De-recognize others' assets. Now the company has approached you to advise. So now you are very good in giving advices. Now you can understand very well, because almost you are done. You are at the end. See, that's why you are able to appreciate these questions. Now because you get all the connection. What should have been done? Why should have been done? Suggest the accounting adjustments which are required to be made in the opening balance sheet. Simple. What is the adjustment? Remove the net assets which you have consolidated. Take it as one item called, what your standard says? Take it as one item called investment. Now, what is the opening value of the investment? Whatever you de-recognize, it's the opening value. But the problem comes goodwill. The goodwill is having two here. Two people goodwill is sitting. So you have to bifurcate, distribute. On what basis? On what basis do you distribute? Net asset basis. No. Generally, goodwill comes how? You pay more than the net assets. So can you distribute based on the net asset basis and tell this much investment goodwill belongs to joint venture? Yeah. Okay. Write the solution, but you have to give some story, no? Simply we cannot go and start. So on transition, they asked you advice to suggest. So your advice will be on transition. See, in advice, you have to, there are some alternatives possible, okay? And you may have to advise the good thing, bad thing, how it is applicable. Suggest means you give the procedures, okay? Yeah, very thin difference there, not much difference. Analyze is the one word. See, students, be extremely careful. Because whenever you see the word analyze, there are a lot of components, and it is expected that you write one provision. With reference to that provision, you check the applications. But one thing is, whatever they say, stories should come here, theory. And your explanation should be self-explanatory for someone to read and get a flow there, what you are telling. Now, on transition, on 1/4/2017, 1. De-recognize net assets of joint venture as per proportionate consolidation method, AS 27. On transition, de-recognize the net assets of the joint venture which you have accounted as per AS 27 using proportionate consolidation method. Second, good, see, in the new syllabus they have streamlined. Inter is full with the accounting standards. No extra items there. Clean, you learn proper accounting standard, intermediate, rather than first group here, second group some partnership, foreign branch. Clean accounting standards. Final, you study clean Ind AS. Very nice. At a foundation level, you study whatever partnership, company. Which you are very clear now when you are coming in here, no? You understand, because it is one breed, accounting standard is one breed. This is an advanced breed. So the transition doesn't take much difficult, it is not difficult. From the foundation level type of knowledge or from BCom knowledge, if you come here, no, you will end up in a different word only, wondering what is this. Okay, next, recognize investment in joint venture as per what? Ind AS 28, not 111. 111 will take only classification. It will not tell you accounting. Accounting is spoken in Ind AS 28. Now, what is the initial amount? Initial amount will be aggregate book value of net assets with the goodwill, because goodwill also you have to recognize, no? And we always say in Ind AS 28 that the goodwill is subsumed. Now problem you have to explain now. Goodwill, the moment you say with goodwill, point number 4 you have to explain allocation of the goodwill. Okay, are you clear? This theory is okay, no? Then point number 4 you say that, since you spoke about goodwill now, goodwill allocation on what basis? Relative book value of CGU. Now your joint venture must be one CGU, parent must be one CGU, your subsidiary must be CGU. Goodwill should happen based on the CGU, no? Who is getting benefit? Because they are the smallest cash generating units. If you want, you can club them, aggregate them. Okay, so this is what you say, the goodwill shall be allocated based on the joint venture, and whatever amount you get, that is considered as the deemed cost of the investment on initial recognition. That is your book value. Okay, so first step is what? See, I have got a goodwill of 1507 on 1/4/2017. This has to be given to subsidiary and a joint venture. On what basis? Net asset basis. Okay, and which assets? Only relevant assets, because ultimately goodwill comes from the difference between your investment made and the net assets. So you have to differentiate. So first is to calculate net assets. Working note 1 or 1, calculation of net assets. So first you explain the accounting, which you suggested the accounting. Now you help them in doing it. So you will take CFS as a group and you will take the joint venture. You will take the group and joint venture. What is the PP of the joint venture? Of the group? Huh? How? Full, no? It is 50%. Okay, for your understanding, what they have given you is not the joint venture's value. What is the sentence there? Let us see, because yeah, it is a different perspective you are reading it. Now you read it, read the sentence, because somebody may misinterpret this. Presently the same has been accounted as per proportionate, the proportionate share of the assets and liability. Have they not used the word called proportionate? Maybe in the exam they may tell that the joint venture assets were so and so. Then you have to take 50%. Asset is so and so. But in the given question, they said proportionate asset is so and so. You cannot make any assumptions there that it is the joint venture's balance sheet there. No, they don't do it. Don't worry. But be careful. You know what you are doing. So it is 1200. Followed, no? How much is the group? All other CGU. Here all the CGUs are 1. Joint venture CGU is 1. Can you tell me other C group? How much? Yeah, 22,000. Yeah, because it's the total divided by proportionate, no? 22,288. Okay, so it's not the, sorry, it's the group only. It is not that we are bifurcating. See, this is for the total. In this total, how much is for 1,200? This has got three CGUs now. Parent CGU is there, joint venture, subsidiary CGU. So when you say goodwill divided by what? Total, no? That total is this. Otherwise, what you should do? If you write others, other two, then you should add. Followed, no? Okay, what is my next asset which should have been calculated? Goodwill. Joint venture, nothing. My group as a whole is 1507. Long-term advances. No, somebody may argue here, telling sir why goodwill we have taken. But okay, they have assumed that is also part of the allocation. Long-term advances, now it's very easy, no? You take 405 from the goodwill, from the joint venture. CFS, you take full. Then, which other items would have gone to the goodwill calculation? Trade receivable you would have taken, yes, simple, 103 level. What all the items you would have taken? Yes, current assets also you would have taken. Would have taken trade payables? Yes, so you deduct the trade payables and you deduct the short term provision. So you got a proportionate net assets. Alternatively, you could have calculated using calculator, but this is the presentation they want. They want to tell like, look, they only give the numbers. In fact, we didn't do addition, multiplication, nothing we did here. But we presented and we got certain totals telling that these are all the totals which we consider for the goodwill allocation to this joint venture. So this is my working note number 1. So now I will calculate the value of the investment, which already we told. What is my value of the investment? The net assets what you derecognize with the goodwill. And then we give an explanation how do you calculate the goodwill by proportionate net assets, whatever, proportion of the net assets. So deemed cost of the investment, net asset of joint venture, how much? 1825 plus goodwill. How much? 1507 into 1825 divided by 23,137. This gives you 1944. This becomes your. Are you clear? Yes, so next what we need to prepare? Balance sheet. Okay, sure. So what I want you to do is I'll just prepare the first one. Then I want you to prepare. So first my non-current assets is PP. Is there any adjustment here? Yes, no, that net assets we have to derecognize 1200. So I'll show as per Ind AS 1088. Like this, I want you to do complete balance sheet. This just like the previous one. So in exam, maybe you have to prepare this as a note. Followed, no? If they ask you schedule 3 format. But it is not a schedule 3 because always we can give, because it's one balance sheet, one column, no actually. It's one column. Yes, students. So please pause the video, work out the complete balance sheet, then we'll check. Yes, students. So we'll check the answers. Yeah, it's a very simple question, correct? Study material question, right? So you have got a goodwill, got reduced to 1388. Investment property remained same because there was no share of the joint venture there. Long-term loans and advances, there was a reduction, and you got one new investment called investment in joint venture 1944. Then your current assets, there is a reduction. Current investment, there is no reduction. Other current assets. So total of the balance sheet is, adjustment is 110 for the assets, 40,965. Any mistakes? Fine, no? Now we will move on to the other equity. Equity to share remains same. Reserves and surplus also there is no impact going to come into on this transition. So you have understood on an independent basis, like how to remove share cap. Previous slide. Any mistakes happened anywhere? Yes, tell me what happened, what went wrong. From where did you take this 31st March? No, 1 minute. Trade. You took balance sheet, didn't tell you, no? You see the trap here? They could have given you one balance sheet. Why they gave you one more balance sheet there? 31st March 2018 balance sheet. It was subject to restatement. When did they ask you to prepare the corrected balance sheet? As on 1st April 2017. So chances are very low that again restate and do it. Okay. But you see, simply they have given you one column. At least someone misinterprets it, no? Gone. Okay, anyhow, good. Mistakes are there. We get a different perspective. We'll understand how people can see it, because each person will see in a different ways, interpret in different ways. So my objective is to learn from you, how do you see it? Okay, so your share capital, and that was the only mistake. Only debtors you took. Inventory also you took from there. Okay, are you clear now? These numbers? Yes, now I'll go back to the non-current. Long-term borrowings full remains, provisions also remains, other long-term liabilities, trade payables, and this. So here also I believe this same thing must have happened. Okay, others fine, right? So understood now how the index is prepared with the transition from your joint venture. Yes, so we will move on to the total equity and liability will be 4965. Yes, so we will move on to the next question. Mathur India Private Limited has to present its first financials under Ind AS for 31st March 2013 and its transition date is 1st April 2011. Is it correct? That means my first balance sheet under Ind AS will be 31st March 2013. This is my financial year, 12-13. Comparative is 11-12 and its first day is my transition date. Now the following adjustments were made on the transition to Ind AS. So straight away they told you the adjustments only in another problem. The company opted to fair value its land on the transition date. Can they do it? Yeah, obviously, no? They can do it. They have deemed a valuation for all, else class by class they can do it. Now, Mathur, following the company opted for fair valuation, the fair value of the land on 1st April was 10 crore. However, book value as per the previous gap was 4.5 crore. Do you pass any accounting entries here? What? Land to retained earnings. Okay, so the difference between your fair value of the land. Now the company has recognized a provision for a proposed dividend of 60 lakhs and a related dividend distribution of 18 lakhs. It was written back as on the opening balance sheet. Yes, because Ind AS 109 very clearly says you cannot pass any. Ind AS 10 also says that your dividend is not a subsequent event for you. It should be accounted on a cash basis, or at least AGM it should have got approved. Then you get a right to receive it, and then you pass the entry, even though you have not received it. So this adjustment has to going to affect your dividend, retained earnings. You have made a provision. So provision, you cannot make a provision only after the AGM. So AGM will happen after your board of directors approve. So it's not even 10 now, so it's only disclosure. So you have to reverse this provision. Company fair values its investment in the equity shares on the date of transition, which you have already come across. Fair valuation increase only straight away, they told 75 lakhs. The company has got equity share capital of 80 crores, redeemable preference shares of 25 crores. Is it going to change? What? Classification, redeemable are going to become financial liability, no? You previously must have shown under capital. The reserves and surplus before transition was 95, representing 40 general reserve, 5 capital reserve. 5 is going to come. Is it going to change 5 capital reserve? No. Why? Because we are going to assume that you are not going to restate the business combination. This is one exemption for you. If you want, but if you want to restate this capital reserve on business combination, then you have to restate all the business combinations. If we restate, then this amount is going to change, no, cumulatively. This is going to change now. Then that effect we have to see where it is going to hit now. That's why generally people will say, okay, Baba, I will just take the closing previous balance. The company identified that the preference shares were in the financial liabilities. See, our assumption it was just before we come, but they told very clearly here. What is the total equity, which is nothing but equity plus other reserve, as on 1st April after transition? So it is just a calculation. Show the reconciliation between total equity as per AS and whatever balance you are going to get here. You have to get one balance, and this balance has to be reconciled with what was the previous balance. Ignore, with the grace of God, deferred tax impact, but assume tax rate to be 30%. This can be ulta. No, chances are very low again. Already we have seen that they will trick us, but not to that extent, okay, which is unknown, no? Because if this type of adjustment we are not seen only. If then we have to, what we need to do? Simple. If there is a deferred tax impact, they should have recognized deferred tax impact. So we have to check any balance sheet items are there, revaluation happen. Yes, we have to create a deferred tax impact, deferred tax asset or liability. Where is the second line? Retained earnings. Otherwise they should have created. No, they didn't create, so we'll create it. If they give me tax percentage is 30%, see, they have not created, otherwise they would have told me deferred tax also. We have to create a deferred tax only on the balance sheet items applying Index 12. And the second leg would have gone to retained earnings. Okay, worst case. Or maybe something like dividend, proposed dividend, yeah, it would have, proposed dividend is a permanent adjustment. What you have never claimed with the P&L, and you will never again claim in the P&L. So you have to see revaluation of the fair value valuation. It can be a, then if they would have told you simply tax, they cannot simply tell you tax. Then they would have told you what is deductible or non-deductible for income tax. Because it is a standalone chapter. No, you cannot expect it to assume what is applicable there. They would have told you specifically what is acceptable, what is not deductible. So from that you would have easily understood the deferred tax related issues. Clear? Okay, first thing we will do the calculation of the total equity. For this I start with the equity capital. How much? 80. You can draw 3 columns. Equity share capital is 80. Okay, next what I will do? Other equity. How much is my other equity? I have got a breakup there. General reserve 40. Capital reserve 5, because there is no change here. This 40 and 5, there is no change. Retained earnings, I will write at the inner column 50, because this is a subject to change. How did you get 50? Oh, tell me, can you tell me the retained earnings balance? How did I get? Okay, I told already, but tell me, how did I get? 95 minus 40 minus 5. Clear now? See, they didn't tell that, huh? Smart people. Now tell me, students, what adjustments are required on transition? Adjustments are already told. You have to just tell me the accounting entry wise, plus bar minus. Should I do plus or minus now for the first adjustment on the fair valuation of the land? Plus fair valuation of land. How much? 5.5. 10 minus 4.5. What is my second thing? Dividend reversal. Plus or minus? Because it is sitting as a provision, no, in the balance sheet. So dividend reversal, how much? What about the dividend distribution tax? When I pay, then I'll do. No, why I should make a provision on something which I cannot make a provision. So it is full 0.78. It is 0.6 plus 0.18. No, because I cannot make a provision. No. Then investment, fair value gain also, that also I am going to add it. So as per Ind AS, my equity balance should have been 182.03 because 80 plus 40 plus 5 plus 57, or I can say 80 is equity share capital, other equity is 102.03. Perfect. Clear, Prithvi? What is the doubt? Yes. Now what did they ask me? They asked me a reconciliation statement as per Ind AS and accounting standard. Now for this first I should know how much is accounting standard balance. No. Okay. Write the heading reconciliation. Equity share capital is 80 plus what else I have? Preference capital 25 plus reserves 95. That's it. This is what I had in my total equity plus. Now this I have to reconcile with 182.03. Can you tell me how should I do? No, but wait, when I say I have to give one heading, right? I should group it, okay, or I should tell why I am doing it. Okay, tell me first from 200, forget about the presentation part. Presentation I will teach you how to do it. What all the adjustments will be there? What you call for them? That's what. Now we will use the previous adjustments only. We will say give the heading reclassification adjustments. There can be so many reclassification adjustments would have come. Which one? We can use it in the previous what you have done. No, same thing we are going to trial, but under each head we are going to classify. No. See, under the previously reclassification was not there. Retained earnings, has it hit the retained earnings? No. So how much are you going to add or minus? Minus, because 200 has it, 182 doesn't has it. So you minus 25. Then fair value adjustments, what you call for that? Can you give any heading? How many fair value adjustments are there? 2. So can you give one heading and tell that too? Remeasurements. That sounds good, no? No, because they have told it. And before that, one more adjustment is there, no? We will write that. Dividend related. What you can call for them? Derecognition. Derecognition, because you don't recognize that anymore, no? You will remove it. So you say derecognition adjustment. proposed dividend, which is not a liability at all. Are you going to minus or did? Anyhow, no problem. No problem, Baba. I'll give you now. Exam question is there. In a study matter also plus minus they will tell you, no. You will see that and solve, right? You understand now why you're doing it. For me, okay. I'll proceed now by telling, okay, you have to add. Do you know why? Followed, no? So why we are added it now? Proposed, because this retained earnings was minused already. This balance has a retained earnings which was already minused and overstated and understated. So you add it backwards to bring it to 182. Followed, no? Don't go with this add minus here. Think from a journal entries. And now tell me, remeasurement adjustment, should I add or minus? Add. Perfect. Very good. Understood logic, right? Because in exam, what you can expect now? There is a fall in the investment value. One land is increased. No, I am telling, I don't know how they have given. What do you think? They will give, okay, now you will guess. If this question comes in the examination, will it come as it is or will they twist it? Twist? As it is? It is there. Next question is that only, I believe. Okay, we'll see that. I feel somewhere, no, I don't know, I really don't remember now. But I feel again, they should give as it is. Why? Because see, this problem looks simple now, Baba. If you sit and try to understand this, first of all, you should have an understanding of transition, no? Somewhere one question is sitting in test your knowledge on an independent basis to solve this. Okay, format wise it looks easy, but to have, you need to know what you're doing here, what is this reconciliation you're trying to provide. First of all, when I thought not to teach at one point of time, what do you think, students? Will they volunteer to study, break their head on this? No, probability they would have left, no? Okay, let us see. So add, remeasure adjustment, both are same. So in exam, one of the item might have got fair valued devaluation. Here both were upward revaluation. And there can be one downward revaluation happening. Possible, no? Then that one you have to minus it. Now then the evaluator or whoever understand that, you have understood the accounting thing here. You are not just gone with one format, somebody gave you one format, do here plus, minus and all. No, you have understood the background, why we are doing it. So that any irrespective of any permutation combinations, you should be able to do. Easy? Now, we will move on to the, what is the time? Next question. 1 minute. Yes, next is your December 21 exam. Yes, students, so please pause the video, do the working. Don't try to look into the previous question, just do it with your understanding. Let us compare the answer. Yes, students, so we'll compare the answers. I think 8-mark question. 8-mark question. Okay, so only one thing is we have seen this adjustment to remaining the same, present the financial statement. So this adjustment the same, previous, this is one new. Okay, foreign currency translation reserve, they intends to avail by resetting it to 0. They want to transfer it to the retained earnings. Investment in subsidiary, this is same. Company has an equity share capital, and okay, this is same. What is the balance of the total, and show the reconciliation. Ignore the deferred tax impact. Again, they said no deferred tax issues. Now, total balance, share capital is 760, general reserve, capital reserve, no restatement of the business combination. Retained earning balance becomes 490. Did you get this? So 52, 7.35, and add cumulative translation reserve 2. So total 978. So you will get 1738.73. Did you get this number? Any mistakes by anyone? Did you interpret or read it somewhere else? What did you do? Okay, you missed that yesterday thing, no? What you have? Okay, forget. In the previous question, cumulative translation reserve was there. Today we today we did one first question where we prepared a balance sheet. In that balance sheet, foreign currency translation reserve was there. On transition date, did company opt anything? It was an option. What was the option? To set it to 0. We have written theory also, no? Set it to 0 means it is an option. If you want, please continue with whatever balances are there, you continue in the new scheme also. Okay, but in the new scheme, what happens? That becomes, see, why this option is given for you? Because previously it is a reserve. Under new thing, it is an OCI item. One option is you take it as OCI, then recycle at the time when you do it. Okay, but then it will hit your P&L account. If you please be careful. If you want to continue with this FCTR reserve, under FCTR reserve it is an OCI item accumulated in equity. And the day you dispose that foreign operation, it is a subject matter of recycling. See, be careful, one day it is going to hit your P&L account. Credit means you are happy, debit is no. That's why I will, if you want, I will give you right now option. Tomorrow you need not hit this to P&L account. So right now take that decision, make it 0 right now on transition date. Now onwards, whatever FCTR is going to come, it is a subject matter of recycling because it is a OCI item. So what you decided, what you opted for, what they said in the question, company had a non-integral foreign branch. Have we not discussed integral, non-integral? With AS11 and recognize the balance as per the part of the reserve. Okay, maybe. See, now you have to make certain assumption. See, when they said here separately, okay, so as per the part of the reserve, have you minused it? So 910 is the, okay, 1 minute. As part of the reserve, yeah, we'll see that. Now, on first time adoption, the company intends to avail exemption, resetting the cumulative to 0. See, one thing is, one part is clear that they want to make this, no, they don't want to show it anymore. So, they should transfer it to the retained earnings. Simple. Whatever balances are there, they should transfer to the retained earnings. Now, let us go here, your confusion. Company has got an equity share capital, redeemable preference share capital in the nature of financial liability. The reserves and surplus balance on 1st April was 910, representing 380 general reserve, 40 capital reserve out of business combination, and a balance in retained earnings. What you have to interpret? Very good. See, that 2 lakh is sitting here or it is extra? Where? Yeah, very beautiful. Now tell me, students, now what did you understood? They said very clearly part of the reserve. Which reserve? But which reserve? It is part of the 910. The total reserves is 910. Okay, if I take this breakup, 910 minus 380 minus 40, 490. Okay, so how much it comes to? 490. Is part of the reserve, they said. So total, in total, you should be getting 380 plus 40. Yeah, understood. Okay, now let us go with the suggested answer. See, here there is a catch, very clear cut confusion created. Now let me see what students have done what. That's what I'm interested. I will tell you there are two alternative assumptions could have been taken here. If you open the suggested answer, they didn't tell you. So alternately, students could have done like this. Then again, I will bring back to you what I have been telling you from day one. Okay, let us see what you have done. First of all, see, you have not done this adjustment, not accepted. Add, I want to see that add, correct? Why? Because it's very clearly, categorically said that they want to opt to make it 0. So wherever it was, we don't know. Going forward, it is going to become part of your retained earnings. So have you added this? Now one more problem comes. If I am going to add it, where I am going to deduct it from? Was it part of your retained earnings? No. Earlier, you think of just common sense. Accounting standard, how it would have looked like? It would have looked like reserves and surplus under this general reserve, X balance, capital reserve, Y balance, retained earning, Z balance, FCTR, whatever, ABC balance. This should have been. If I add all these four, what it comes to? 910. Because they said very clearly that your general reserves and surplus balance is 910. So they should have been 4 breakup. Out of this 4 breakup, this 2 will get reclassified into retained earnings now. But the problem here is, if you add all the 4 in the suggestion, no. Means they said what? Reserves 380 is this, 40 is this, balance retained. That means they literally left it. Or alternatively, you have to make an assumption here that the accountant must have placed this under some financial liability. Otherwise, you have to make an adjustment from some of the other reserve. No, where it is sitting? If it is not, see, they said very clearly that your reserves and surplus is 910, and there are only 3 breakup called the 380, 40, and 490. If this was the case, and already one FCTR is there, where that FCTR is there? Not there. Now, see, if you tell that, sir, it is already part of this, which you cannot tell. Why? General reserve is different from foreign currency translation reserve. You cannot tell it is part of this. Capital reserve is totally different from foreign currency translation reserve. Will you tell it is a part of this? No, they said the balancing figure is retained earnings. Then the only one assumption you can make here is that this foreign currency translation reserve is not sitting in the reserves and surplus only. As a part of reserve, but where it is reserve? Now there is a very clear cut decision. Now you got into confusion. In the examination, you want to think. Now when you think, first of all, you will not touch this. You leave it. Don't think now. See, the moment you get confused, you more think, nothing is going to happen. That means this question should not be pursued now. Go to the next question. Leave some space, go to the next question. That should be the default strategy, student. You think, no, what you will get now, tell me. You will think another 10 minutes. What clarity you are going to get on this? Another 15, take 5 minutes from my pocket, I will give you. Chalo, 15 minutes you think on this. What clarity you are going to get at that point of time? Nothing. Nothing. You have to take one decision now. Followed, no? So this is not the time to take the decision. Just leave some space, go to the next question. Attempt things which you know very well, where there is no catch. Again you come back. What decision you will take? What you remember in the study material? Just try to do as per that. Followed, no? And otherwise, if you sit and think, no, you will sit and think only here, because there is no clarity over this particular point. This is what they want you to do. This is what you, for that 8 marks or 6 marks, they want you to spend your valuable time, your emotions, lot many things on this particular part. So be emotionless, just leave it, leave the space, go to the next. Followed, no? Yes, very nice trap. Huh? Now let us, okay, hopefully Then you remembered what sir was telling you all time in the irritating all time in the classroom. Dump what is there in the study material. What? At the end, you started simply to dump. You said, look, this is my balance, and you did that 2 add, but that 2 you didn't deduct anywhere. Means your assumption is that 2 is part of the reserve. Maybe it is a print mistake there, extra something some has must have come, or it must have part of reserve presented separately somewhere else. Because it's part of reserve means its name is foreign currency translation reserve, but not shown as a reserve. Otherwise, they should have done this adjustment for 2. Where they have? Retained earnings balance should have been 488. You took 488. No, that's also fine. If you take that assumption, that is also fine. Assuming retained earnings balance should be 488. Then it becomes 490 after transferring. Yes. Next, equity share capital. Did you get 1850? Reconciliation. Okay. Did you add transfer minus 180 reclassification? Did you propose dividend 7.35? Did you do? Added it. Remeasurement, there were 3 adjustments. You added all the 3 because it is going to increase your retained earnings balance. See, this itself shows that you are adding 2 to 910. That itself shows that it is not part of 910. It was a trap. Did you get 1738.73 from 1850? Okay, now tell me, students, anybody got this perfectly as they have done in the suggested answer? See, now what assumption you took? Probably you might have ignored it. You may not have thought so much things about it. You must have gone just like the study material way. That worked for you. No, alternatively, some students could have taken certain assumptions. No, this part of the reserve, maybe part of the retained earnings. They might have split. That also may work for them. I'm not telling, I'm not denying that that is wrong. With proper assumptions, that is also proper. But in suggested answer, they are not given the suggestions. But you are reconciling not liability, no, you are reconciling only equity plus reserve, other equity. Equity only you are reconciling. In your balance sheet, you have got equity and liability. Under this equity share capital, other equity. You get one total. Then you have got liability. They are asking this reconciliation under accounting standard with the Ind AS. So this FCTR must have been sitting here somewhere. Proposed dividend was a liability portion. What accounting entry you must have passed? No, what accounting entry you must have passed? Proposed dividend. For recognizing in the accounting standard. You must have passed one accounting entry, retained earnings account debit, because it is a post P&L, to proposed dividend. Now you don't need that proposed dividend. So what entry you will pass? You will reverse it. By reversing, you will add it. Are you clear? Perfect, students. All mistakes, you have seen the traps? Yes. So next question, very nice, beautiful, important, and the last question. Shaudya Limited.